North American Income Trust has an objective of a good and attractive level of income, which will grow through time. And also, we obviously want to see capital growth from the portfolio of predominantly S&P companies. The S&P historically has yielded less than 2%. Yields are rising, despite the market going higher. Yields are rising. And we do think we're in really the early stages of a refocusing of corporate America into dividends. We know that the GDP backdrop is better than it was, but it's still fairly modest or moderate. And therefore, there is this saying that investors want to be paid to wait for better growth. The investment process, as you won't be surprised to hear, is Aberdeen's equity process. That's very bottom-up focused through constant meetings with the management team to enable us to get an understanding of the strength of the franchise, the quality of the management team, their risk aversion, how they're paid, and also to get an understanding of where the cash is generated from and their ability to distribute it. We've given ourselves the ability to use some bank debt. We have a bank line of £30 million, of which we've drawn half down. We've also given ourselves the flexibility to use some bond holdings to supplement the income side. Typically speaking, 80% of the trust's income will come from the equity portfolio and 20% will come from the bond portfolio. What we have seen in the past 6 months is the economy has begun to get better as people are more comfortable with the resilience of it and the direction of GDP growth. At the margin, we've moved a little bit of exposure away from the more defensive areas into what you would call traditionally the more cyclical areas, like materials or technology or industrials. What we've done with that marginal shift is to make sure that those companies are still good quality, they're great on cash generation, and they have a willingness and an ability to pass that cash back to shareholders in the form of dividends and dividend growth.